Would you like to join us for 3 interesting webinars this Saturday? Let's look at what we have in store for you. At 10 a.m., we have a webinar that will discuss the importance of SIPs and lump sums in your investing journey to acquire your dream house. If you are dreaming of buying your own property, this webinar is definitely for you. Don't forget to register. At 11 a.m., we have a webinar on how a true active strategy can unlock potential in India's large cap space. Register using the link in the description. And finally, at 12 p.m., we have a webinar that will explore the tax dimension of multi-asset investing, which will take into account the updates from the budget as well. We hope you can make the most of it and also hope to see you all there.
Are we taking too much risk? This is the topic that we are going to delve in this episode of Talking Straight with Subramanyam. All of us now want better returns. We want to improve our returns. We want returns not quite connected to inflation, not even connected to benchmarks. We want returns that are far more outlier than just benchmark returns or inflation. This expectation comes from our recent experiences and could very well be called a recency bias. I see a lot of people think that it's very easy to compound at the rate of 24% for the foreseeable future. And in that expectation, they also are willing to take risks which they would otherwise not take. So, having the wrong expectations can make us take the wrong risks. And if we do that, what would happen? Inevitably, we would take risks when we ought not to take them, and that in turn would leave us with significant losses in our portfolios, and we would be trying desperately to come out of that loss. In the process, we would lose very valuable time, and our best case would be regaining capital. This is what happens to most investors who take too much risks. But there are investors who climb out of even such deep trenches which they dig themselves into. What do? Well, they start again at the bottom. They start afresh and chart out a new journey by using whatever capital they can salvage at the bottom and then applying it afresh. Now, this is not something the average investor does. This is something which is done by the rarest of rare investors. Others simply wait for exactly the stocks where they got bruised to heal. And it takes endless time to heal, but they patiently wait. But the other people show their impatience at the right time and then go into better stocks and then make their waiting worthwhile because they are able to come out of it in flying colors. I'm going to ask Subra, what would you do if you have a portfolio of companies that you built very aggressively in the last 18 months, which is now down 20% or 25% from the peak valuation? What would you do?
So, most of my life, if I made money, it is because I've cut losses very quickly. Because I wouldn't let my losses run too long. I have to believe in the company and all that. But still, the market is telling you something which you couldn't see or you didn't want to see, whatever be the reason. So, I would not accumulate too much of a portfolio which too much of losses. I mean, whole aggressive portfolio, maybe 2% or 3% of my portfolio, so it won't hurt me too much. But yes, I realize that I've made a mistake and I get out quickly, saying something is wrong which I can't see or I don't want to see. So when you see something like, you have to have strict rules and two types of stop loss. If you're a trader, maybe a 10% stop loss. If you're an investor, maybe a 20-25% stop loss. But you have to have a stop loss. When the 100 rupee share which you bought comes down to 75, the market is telling you something which you are refusing to see. So you get out at 75 and say, okay, I took a 25% loss. You have to do that. You can't wait for a 100 rupee share to come down to 9 rupees and say, oh my God, I lost everything. That's just not right. You should not have waited that long.
So you're saying that you want to deal with bad losses ASAP,
Yes,
as
very
fast as you
quickly,
can.
very quickly. So if I put 20 lakhs in a company and I find that it has come down to 16 or 15 lakhs, I just take a 5 lakh loss. It hurts very badly, but you have no choice.
How do you decide it's a decision which you have to take? Like, how do you decide on the merits of the company at that point? You bought for 100 rupees, it is down, let's say 80 or 75. At that point, is price the driver, or you do some homework, you check with people, or you go and do a re-evaluation, or how do you come to this point where you make this decision?
No, Shyam, at that point, no, there is this bias which says, no, you are not wrong, something is wrong with the market. Market does not know how to value, so you are right. All that I talk to myself till it reaches 75. When it reaches 75, I say, no, I'm not hearing something or I'm not seeing something.
So you don't go to anyone?
Bias. At that stage, I get up. At some stage, you have to forcefully do an exit. It could be bad, could come back to 100 again, but at some stage, I need to cut losses and run. If it is an amount which is going to hurt me, if I put 5 lakhs and this loss is 1 lakh, I may let it run, I may talk to somebody, but if it's a bigger one, I have to get out because I am not seeing something which I should be seeing. The market is telling me, the market is slapping me, the market is telling me this promoter is a dud. He impressed you with a stock, but he's actually not a good guy, or something is wrong with the company. Something is wrong and you don't know. There is no way how you will know. You are not a crystal to get quarterly returns with full details and all that. So something is hiding from you. I get out. I take the loss because if it goes down even further, at least I'm saved. If it goes up, bad luck. That's all. And if it goes up from 75 to 80, it doesn't bother me too much. If it goes from 75 to 100 in 2-3 days, then I kick myself to ask myself what happened. But I don't bother too much. And it will always be a small position only because I don't build positions very quickly. After buying at 100, my next buy would be at 110 or 120.
So you average up.
Yeah, I average up.
But generally, people go to the echo chamber, try to get views from people who told them to buy. They listen to views which favor their holding on. They never go and ask a person who will tell them to sell, and they never tell themselves to sell. What can such people do?
So when brokers tell you some of these things which are not very palatable and you think you have made a mistake, you have to cut losses because there is some reason why somebody was rigging the share up. Maybe there is some fund placement coming, or maybe there is some family settlement going on, some reason why somebody has rigged the share up and you got caught in that storm. So some of these things happen. It's not that these things don't happen. So if you're caught in the wrong end of the stick, then you better come out of it and act accordingly. But if it's genuinely the whole market is down, if the whole market is down 20% and your share is down 25%, just bad luck. Maybe somebody is exiting positions or things.
Bro, you are from an era where you had a broker whom you talk to.
Yeah.
Today they are all online.
Yeah.
Who will they talk to? They don't have a broker whom they talk to.
Actually, I have no clue how they invest because any share, after I am convinced that's an 8% yield, promoter is good, everything, I still need to sound out my broker and he'll say, no, but something wrong is happening. The share price has been recently hit down, something happened, so don't invest. So sometimes, most of the times he talks me out.
Okay, even if you are, let's say, somebody who actually talks to a broker investor, because there are a lot of people who do this. There are a lot of people who are purely online investors who have nobody to talk to on the broking side. And there are investors like me, I don't ever talk to my broker. I don't have a broker whom I talk to. My dealer talks to the broker to execute. So there is no broker in this process. I only talk to my analyst. There is no external person. Or I talk to my peers with whom I have comfort discussing a particular idea. So probably we can say that go to somebody with whom you have already discussed the idea.
Correct.
A peer or a broker or
somebody who in the market who knows.
Somebody who knows the idea.
Who knows that.
Try to get validation.
Correct.
Or try to get revalidation.
Correct.
Or try to get a new direction. All three.
Yeah.
But even after that, most people sit and pray that something will happen that they will get back their cost.
I don't know. I've always held that hope is not good strategy. You're just hoping that something will happen. That doesn't happen. I mean, yeah, you thought it is a great industry. You thought it's going to do well. You thought tourism is going to do well. All that you thought. Amazing things are happening in the tourism industry. But your company, which is in the tourism industry, is not doing well, or it has actually fallen in the time when everybody else is going up. What do? You have to get up. In the same industry, let's say hospitals, there's one hospital which is going up, the hospital which you have bought is not going up, it's going down. There is something that is leakage. You arrive at the revenue per bed, you can see occupancy and all that, but if others are doing well and this company is not doing well, there is something wrong. See, ultimately the business has to be good and the promoter has to be good. One of them is wrong, you have to exit.
Essentially, you're saying that if your risk taking is wrong, you need to walk out. Somebody is not going to guide you out of it.
Yes.
And you may take some help or support, but in the end, it's your own call. That's the point you're saying.
Correct.
What about the whole strategy of taking high risk? For example, I know people who have only portfolios of high risk stocks, pure high risk stocks. And let's say they are bought purely based on price to sales, because that has been the popular metric of this bull market. And suddenly, it looks like price to sale may not matter at all. Then how will they recalibrate? Because you have bought on a metric, your investing has been done on a metric that sales will take care of the valuation that you're paying. When you go by price to sale, you are assuming that sales growth will take care of the valuation you're making.
Correct.
As fair.
Correct.
And buying. So, the judgment is that sales growth is there and it is sure, certain, and it will take care of everything else. And then suddenly people realize, no, it's not so simple. This sales growth is going to come at the cost of profit margin.
Correct.
It's coming at the cost of too much of working capital. It's coming at the cost of many things. And eventually the company is not going to live up to the profit expectations or the expectation of profit growth. So the high risk taking is not going to play out as expected.
Correct.
At that point, what should the investor do to revisit his judgment? Because the metric itself is looking very shaky.
See, it's difficult because let's say you bought Paytm at 1800 and you don't get out at 1450, which is my price for getting out, because I bought at 1800, 25% down, at 1450 I have to get out. I will get out at 1450. I mean, today it is 385 or whatever, it had fallen to 388, 340, 350, and now it is 900. I would have exited at 1450.
So you won't wait for 385?
I can't.
Nor you wait for 900?
I can't. I don't know. It came to 370, now it is back to 900, but I would not have waited that long. I would have got out at 1450. I am like that. It's not right or wrong, but I would have bought it again after it has fallen dramatically. I would have revisited my working and said, look, if at 1800 I thought it was a good buy, at 350 it can't be a bad buy. So I may revisit, I may relook, I may talk to somebody. At that stage, yes, but at 1450 I will get out once. That's what I do. I mean, that's what suits me, because I don't want to take shares below 20%. That's what I do. It works for me, but it does not mean that because it didn't work in Paytm, I will get out of Zomato at 200, saying it didn't work in Paytm, so it won't work in Zomato. No, I think these are similar businesses, but they are slightly different also. Somewhere it will work. So tomorrow, if Uber, Ola, everything is listed, you have something to compare. Today you have Zomato and Swiggy, you can compare. But otherwise, it's very difficult. I mean, you could not compare HDFC Bank to ICICI Bank. This is what I used to tell people.
For a very long time.
For a very long time, because all the subsidiaries were in HDFC Limited. The mutual fund, the insurance were all in HDFC Limited.
But later, people started comparing every bank and calling it the next HDFC Bank. You had IndusInd, then you had RBL, then you had
Axis, Yes Bank, everything.
Yes Bank, everything became next HDFC Bank.
No, but you know, in your portfolio, some good shares which you have been lucky to buy, and you have found out that they are good. Like I entered HDFC Limited in 1978, but I think it took me till 1990 to realize this is a good one. The minute you realize it's a good one, you just let it compound. Maybe it will compound at 3% for some year and 27% for 1 year. On an average, it will give you very good returns. The TRI on the share.
Can you of small companies today? What logic
It's
you are-
very difficult. It's very difficult.
So if the risk taking is wrong in a small company, what would you do? For example, I may tell you, Subra, buy some radio stock or a dish TV type of stock, some company in such a business. It looks optically cheap. I tell you, Subra, buy these companies. They're all very cheap. Radio stocks are cheap. Let's say Enil or the other one. I'm telling you to buy those stocks. And then you buy those stocks. Then the stock falls 25%. What would you do?
I'm out.
You're out.
I'm out.
So irrespective of it being cheap,
Because there is somebody who is not telling me that it is not a good stock. But the market is telling me that at 100 rupees this was not a good buy. At 75 rupees, so you made a mistake. So at 75 you get out. What else can you do? Because you can't argue against price. Something is happening. Maybe some competitor is beating it down to buy it. But
so
I
you are
don't
saying
know.
that if a stock is storified and marketed to you and you bought it by mistake,
Yeah.
if the price tells you something else, you will just
I'll believe the price.
cut the story short.
I'll believe the price, because if I don't, at what stage will I get out?
And you are okay with losing some good stocks like that.
Yeah, it's okay.